The RRSP, one of the greatest tools we Canadians have to save for retirement. We get a tax break during our earning years, and the goal is when we eventually retire to pay very little tax. Ready to maximize your RRSP? Welcome to your 2021 RRSP guide. Let's get started. An RRSP is what's called a tax-advantaged account, meaning the government specifically created them to help those who invest in RRSPs to get a tax break as a way to motivate them to save for retirement. The tax advantage assumes that you invest in your RRSP when you're in a higher tax bracket, as this influences your RRSP tax refund when you eventually file your taxes. Later in the video, I'll go into much more detail on how your RRSP contributions impact your tax returns. When you retire, the assumption is that you are in a much lower tax bracket than compared to your peak earning years. This way, you pay the least amount of taxes when you eventually withdraw from your RRSP. Important point to remember, an RRSP is not a tax-free account, it's a tax-deferred account. You get a tax break now, but you will have to pay tax when you start taking funds out. This is different than a TFSA, where you get no tax break for contributing to your TFSA and pay no taxes when you withdraw funds from a TFSA. Timing your contributions and withdrawals is very important on your way to maximize your RRSP. In this video, I will cover everything you need to know in order to maximize that RRSP of yours. And if you keep watching, I'll let you know what I keep inside my own RRSP. Who is eligible to buy RRSPs? If you have earned income, a valid SIN number, and have filed taxes, you can contribute to an RRSP up until December 31st of the year you turn 71. After this age, if you continue to have earned income, you can contribute to a spousal RRSP up until December 31st of the year your spouse turns 71. Maximum contribution limits. Your allowable RRSP contribution for 2021 will be the lower of 18% of your earned income from the previous year, the maximum annual contribution limit for the taxation year, which you can see in this chart, less any company-sponsored pension plan contributions, also known as PA or pension adjustments. Let's look into more details of the numbers specifically for 2021. The maximum annual contribution limit is $27,830. If we do the math, for you to be able to hit this limit, your 2020 earned income must be at least $155,000. Otherwise, your contribution limit for 2021 will be 18% of your 2020 earned income, less any pension adjustments you may have from a company-sponsored pension plan. So far in this video, I have mentioned the term earned income a few times over. But what does that really mean? What is earned income? For most of you watching, your earned income for RRSP purposes will be box 14 on your T4 slips. Earned income also includes net income from self-employment, CPP or QPP disability payments, and net rental income. Income sources that do not qualify as earned income includes investment income, pension income from your RRIF, old age security OAS, CPP, retiring allowances, death benefits, income from capital gains, and limited partnership income. That's all the background on contribution limits and how much you can contribute. But how do you find out what your actual contribution limit is and who keeps track of it all? After processing your tax return, the Canada Revenue Agency sends you a notice of assessment, which includes your next year's contribution limit. This document also shows you your unused contribution limits from prior years. The other option is to log on to your online CRA account. Go to the RRSP and TFSA tab, then click on View RRSP Details. There, you'll find the RRSP deduction limit for the current year. It will also show you prior deduction limits and your contribution history. You can also see how the CRA actually calculates your RRSP deduction limit based on your actual earned income. I personally find this information very useful. That way I can actually estimate my own RRSP contribution limit for the next year, even before the CRA sends me my notice of assessment. Especially if you're filing late in April, your notice of assessment may take some time to come through. So it's a good idea to know your RRSP contribution limit for the next year early on. Transferring investments to an RRSP. Other than transferring cash to your RRSP, alternatively, if you hold investments in a non-registered account, you can transfer them to your RRSP as an in-kind contribution, as long as they are qualified investments. Two very important points to note on this kind of transfer. One, if you're transferring shares or other investments on which you have a loss to a registered account, you will not get that capital loss, meaning you will not be able to use this capital loss against capital gains. Point number two, if you're transferring shares or other investments on which you have a gain to an RRSP, you will have capital gains and will have to pay tax on those capital gains. Unused and carry forward contribution room. RRSP contribution room accumulated after 1990 can be carried forward to subsequent years. If you're unable to maximize your RRSP contribution this year, you are allowed to make up the difference in later years. Over-contributions. The government has set a $2,000 lifetime over-contribution allowance on the RRSP. Your over-contribution can be used as a deduction in future years. For example, let's say by mistake you over-contributed to your RRSP this year by $2,000. This can be used as part of your deduction the following year. Over-contributions in excess of that $2,000 allowance will be charged a 1% penalty per month. Spousal RRSPs. All or a portion of your RRSP contribution can be made to an RRSP in your spouse's name. As a contributor, you get the deduction, but your spouse is the owner of the plan. This also includes common law spouses as well. If you expect your spouse's retirement income to be lower than yours, then a spousal RRSP may be the best form of future income splitting. Please remember, the effective use of a spousal RRSP requires planning ahead. Don't wait until it's too late. So talk to your CPA or your investment advisor on how spousal RRSPs can be an effective planning opportunity for you. So far we've talked about what is an RRSP and how much you can contribute towards an RRSP and the various contribution limits. Let's look at now the deadlines behind the RRSP. The deadline for the RRSP tax contribution for the current year is always 60 days after the end of the previous year. For contributions to count towards 2020, the deadline is March 1st of 2021. Make sure you consult with your financial institutions on how they can accommodate your RRSP deadline. Contributions made in the first 60 days of the year can either be applied against a previous taxation year or any subsequent years. If you're turning 71, first of all, happy birthday. This is the last year in which you can contribute to your RRSP. You must convert your RRSP into an RRIF by December 31st in the year you turn 71. The marginal tax rate. Make sure you know your marginal tax rate. One of the most important benefits of the RRSP is the tax deduction for the current year. While most people put money into an RRSP to save tax, many actually don't know how much tax they're actually saving. The easiest way to determine the benefit of your RRSP contribution is to know what your current marginal tax rate is based on the combined federal and provincial tax rates. I'm going to show you an example on how you can actually do this. One of the best ways to estimate your taxes is to use an online tax calculator. I have an example from Simple Tax. So you can see here I have the Simple Tax tax calculator. Let's choose Ontario. And let's say your employment income is $100,000. You can see that your marginal tax rate based on the combined federal and provincial rates for Ontario is 43.41%. Meaning for every $1,000 you contribute to your RRSP, you will get a tax break equivalent to this rate. So let's say you contribute $1,000. Notice how your tax savings are now $434, which is equal to your marginal tax rate. Now this doesn't mean for every $1,000 you get 43.41% as a tax savings. Let's see what happens when we increase this deduction. Notice your RRSP savings is now just under $7,000, and your marginal tax rate has dropped to 31.48%. This is because the more you contribute to an RRSP, it actually lowers the tax bracket you're in. And the lower the tax bracket you're in, the lower your marginal tax rate. If you're making a large RRSP contribution in any given tax year in order to play catch-up, consider only claiming enough to reduce the tax burden on your top marginal tax rate. You can carry forward the remaining contribution room for greater tax savings in a future year that is taxed at the highest tax bracket. The Home Buyer's Plan. With the Home Buyer's Plan, you can take up to $35,000 from your RRSP to put towards a down payment on your first home, and you won't have to pay tax on that withdrawal. However, you do have to pay that money back into your RRSP over the next 15 years. The Lifelong Learning Plan. With the Lifelong Learning Plan, you can withdraw up to $10,000 or up to $20,000 in total each time you participate in this program to help pay for your education. All you have to do is pay back 10% back to your RRSP over the next 10 years. You have to start making repayments to your RRSP on those board funds 2 years after your last eligible withdrawal, or 5 years after the first withdrawal, depending on which due date comes first. All amounts withdrawn from the RRSP for this LLP program have to be repaid back to your RRSP within 10 years. What happens to your RRSP when you retire or pass away? When you retire, your RRSP turns into a registered retirement income fund, also known as an RRIF. With this RRIF, you can now make withdrawals, but any withdrawals you do make will be taxed. If you pass away, however, your RRSP is usually rolled over to a beneficiary on a tax-deferred basis. The beneficiary will be named by you. But if no beneficiary is named, then the proceeds of your RRSP are considered a part of your estate and will be distributed accordingly. Does contributing to an RRSP impact Old Age Security, or OAS? Contributing to an RRSP does not impact Old Age Security. Where you need to watch out is when you start withdrawing from the RRSP. Once your net taxable income during retirement reaches a certain level, your OAS can be subject to a recovery tax, also known as a clawback. That was a lot of information to cover for an RRSP: contribution room, limits, withdrawals, taxes, and everything in between. Now the question is, what can you actually put inside your RRSP? Let's take a look at some investment ideas for your RRSP. Making good investment decisions is crucial for the long-term growth of your RRSP. I personally invest in ETFs inside my own RRSP. And if you're looking to get started on some investment ideas for your RRSP, I've done the work and research for you and have made videos on various ETFs and stock picks that you can use as a starting point. Feel free to check out any of these videos on ETF ideas and stock picks that can go inside your RRSP. And that's all I have for this video. Thank you so much for watching. Make sure you hit that like and subscribe button, and let me know in the comments, how are you using your RRSP? I'll catch you guys in the next one.